Capital Record, where we defend free enterprise and capital markets because we believe in the dignity of the human person. Hello and welcome to David Bahnsen's Capital Record, brought to you by National Review, where today we are going to do something that we only did, I believe, twice all of last year, which was bring a guest on. Many of you right now are thinking, thank God I'm going to hear less of David's voice today. But that is only the second reason you can thank God right now, because the first is that the other voice you'll be hearing is our very popular longtime guest and one of my dearest friends, Rene Aninao of Corbu, who is going to spend the next hour with us just literally talking about geopolitics, the market, the Fed, and the macroeconomic things that are most on Rene and mine's mind. He has been on Capital Record every year since we started the podcast. Rene does not do a lot of media and appearances like this, so it's an honor to have him, but it's also an honor just to be able to have this discussion and let you all, the listeners of Capital Record, partake as Rene and I wrap together a little bit. With all that said, Rene, welcome back to Capital Record.
David, it's great to be here. Great to be home, as I always say. It's a historic day, actually. It's the 4-year anniversary of the war in Ukraine, which I think is my 4th year running this, I think, right?
Yeah, I think you're right.
So, good day to be here.
Well, and there's certainly been an awful lot since the war in Ukraine that has given us opportunity to talk on what it means for the world stage and so forth. You know, we began talking at the beginning of the year about getting you on. And when I first sort of reached out and said, we got to make this happen, it was a day or two after President Trump's successful mission to out Maduro in Venezuela. And yet, since then, you could argue that not a week has gone by without significant matters of that warrant discussion, both globally and even within kind of U.S. Domestic policy. In the interest of trying our best, I don't think you and I are going to do a very good job, but in the interest of trying our best to stay focused, why don't I just sort of start us with what has been one of the larger domestic issues that has happened so far today, which was President Trump's long-awaited announcement of his choice to be the successor of the chair position at the Federal Reserve, Kevin Warsh, somebody both you and I know, and both you and I predicted would get the nod. And
I think we were the only two.
Yeah, for a while we were. And yet I will say, I'm a person who says, don't tell me what you believe, show me your portfolio. And I never did go place a bet on Kalshi or polymath. So perhaps I would have had more credibility. But I was on record on television and in writing a full year ago predicting he would. And I think you and I have gone back to 2017, hoping that Warsh would end up on the Fed. Let's start with that, Rene. Why are you happy about Kevin Warsh being selected?
I mean, look, I think there's a few points to really think about of why this nomination was so important. I always like to start with that it really reveals something about the president's reaction function, which is that he knows implicitly that he has to submit himself to market discipline. And, that's a very, I think, out of consensus view, but it's very clear when you look at what the president does. The one place where he submits is to the markets. And I think that was just a very interesting point to kind of start out with, that I think leading up to the nomination, the historic nomination on January 30th, there was this long-running narrative that the president wanted a sycophant in there because he wanted lower rates and he wanted to, let's call it, twist the Fed into what he wanted them to do. And I think that he intuits always that the market will not reward him for that. And if he's subjected to market discipline, actually, it's going to be worse for him. So he knew that nomination was different, and it was special, and it was important. And he picked the best person for the job, which I think is obviously Chairman Warsh. I think the other thing that's really important about the Warsh nomination is that, you tell me, David, but over the last several months, maybe even years, there has been this concern that the central bank was losing its independence, and that had major implications for US markets, the US place in the world, the US dollar. Um, and I think that now has been put at least to rest. That is no longer a question anymore, that the central bank has and is going to restore its credibility. So, when you think about what that means, maybe we should talk about this in more detail, is what the Warsh agenda is.
Well, so let's get to the Warsh agenda, but let's start with the connectivity that you're positing between market discipline and Warsh's selection. Is it about Warsh's selection that reinforces market discipline, or is it about the rejection of the other sycophantic candidates?
I think it's both. It's a great question. But the fact that he chose to not nominate one and chose the very adult in the room, let's call it establishment choice, I think speaks to the point that I always try to make, which is that the markets are always the final arbiter. And every head of state that stays a head of state for a long time always has to submit to market discipline. I mean, you and I kind of laugh about that on, the infamous Liberation Day, April 2nd last year. I think it took a total of 7 entire days and maybe 40 basis points higher in the long end for the president to submit to market discipline.
5 business days, 4 market days.
Yeah, there you go.
4.5 if you count the intraday. But yes, I mean, that was a pretty powerful reinforcement. You've done a lot of work, Rene, reinforcing this, even in bigger picture issues. You could argue that the Clinton, Rubin, Greenspan trifecta was entirely governed by market discipline throughout their longer term reign. It wasn't as dramatic of a moment. I mean, you could look at long-term capital or whatnot, but there are various examples of this. But when you say all states end up having to submit, is it true in third world countries, or is it not true in third world countries, and that's why they're third world countries?
I think it's exactly like what you said in the latter, is that the reason that they are third world countries is because they choose not to submit to market discipline. That's why Venezuela is what it is. That's why Russia is what it is. That's why most of the emerging market complex is still emerging, because they have not embraced the capitalist system. And obviously that's the title of your podcast, right? The Capital Record. And you and I talk about this. I mean, this is a theological point that markets are God's will here on earth.
Mm-hmm.
I know that sounds very almost hyperbolic to say in this environment that we live in, but I think I believe it very much, and history bears.
Well, by the way, we should interrupt, because I would love to take for granted that the listeners of Capital Record all know what we mean. It is the point of the podcast, but it's also very susceptible to people just flat out bearing false witness about what you said. You didn't say markets are God's will here on earth in the sense that God wants every market transaction to be a successful one for both parties, or that there will never be downside to risk, only right tail outcomes. That what you said was markets, and markets properly understood you're making a comment about human freedom and human exchange and human relationship of exchange, that is God's will, and that is non-impoverishing, and it is promotional of flourishing, and that is God's will on earth.
And it's ultimately about the creation narrative that you talk about, right? That is our calling here on earth, is to create, and that is what markets enable us to do. So, and when we do those towards, let's call it the aims of of other humans, then we're rewarded for that. And when we conduct ourselves in markets in ways that are exploitive, then we are punished for that, quite frankly.
So with market discipline applied to the political sphere, and now we're not talking about a head of state in Venezuela who doesn't honor it and makes his country poor because of it, but a situation like America, we have a long precedent of presidents going against market principles, right? We have precedents of presidents that want greater central planning, greater interventions, greater imperial or discretionary authority. How do you distinguish between market discipline in those extreme moments, like post-Liberation Day, and market discipline where on the margins they use New Deal or Great Society or Dodd-Frank to push the envelope of anti-market state intervention?
I mean, look, I think that's it's a great segue to one of the pieces that we wrote, I think earlier in the year, at the end of last year. And we called it No Mas, which was that the markets had told the United States, it's over, no more on the fiscal irresponsibility. And let me run through this just super quickly because I think it's interesting and important. When the Federal Reserve started to lower rates in September of 2024, shortly before the election, by the way, right? We saw 175 basis points of interest rate cuts. And despite those cuts, the 10-year yield was higher today than it was in September of 24. The 30-year yield, higher. Term premia, higher. And so
For those who want to nitpick, that has been true. It may just recently have moved,
correct.
but yeah, understood.
Well, what's interesting also on a side note is that when the yield started to come down was after what I call the Warsh restoration at the central bank, right?
Yeah.
Which is that when markets finally start to see that responsible decision making is being made, then they will reward that with lower yields. But here's where I think maybe we can think about connecting it to geopolitics and the US's place in the world. There's been this, I think, focus in the new Trump administration about that we are going to focus only on the Western Hemisphere. Maybe arguably even at the expense of other regions like the Middle East or even Asia, that we needed to recalibrate our force posture all around the world. And I have this chart where it shows that U.S. defense spending is now lower than the debt service cost. So we spend more on servicing our debt than we do on the national defense and underwriting the global security environment. And I think that is an outgrowth of, to your point, David, I think almost, 35, 40 years of refusing to abide by market discipline. So here's the example. Think about 1991 up through 9/11. US debt to GDP was around 35, 40%. And after the Cold War and the peace dividend, I'll argue that much like the Europeans that are much derided for squandering their peace dividend on social programs,
Yeah,
the United States did the same.
sure.
Because we squandered it on housing. We squandered it on bank bailouts. We squandered it on buying votes during the pandemic, right? Such that now I think that what the markets have taught us and told us is that this whole idea about focusing on Western Hemisphere is not necessarily just a discrete policy choice. It is the markets imposing discipline on us by telling us that you will not be able to project power globally simultaneously around the world until your fiscal house is in order because you cannot afford it. you've gone from 35% debt to GDP to 125% debt to GDP, and it's only supposed to get worse. So you can't afford to spend as much on defense, right? So I think that's, probably, and I will say this, we mentioned to the clients that this is, I think, the most important note that we ever wrote, is that even, the almighty superpower United States still has to submit to market discipline, and that there are real consequences when it does not.
So with Fed, with the Fed independence issue, you and I are in agreement that a Kevin Hassett appointment would have undermined Fed independence, both in market perception and very likely in the administration of policy. I won't speak for you on this one. I will say my reasons for saying that is simply that I don't know what else to think in light of 35 years of Hassett's record, 34 of them being decidedly one way in terms of most issues of public importance, and then the 35th year being so different. It just calls into question the resolve and the willingness to adhere to various principles and ideological commitments that you would expect. If I'm wrong about that, if Hassett would have gotten the job and come in and been an independent central bank head, then I'd be happy. But it's certainly a plausible belief he would not have been, based on the way a published author, advocate of free trade, has changed his views based on the notion of inflation numbers that were X during a Democrat administration being inflationary, and then numbers that are higher than X now being disinflationary. We just have a sycophantic run that's going about 12 months that honestly I've never seen. You could say, well, Pete Navarro is sycophantic, but Pete Navarro came in as a sycophant.
Yeah, that's right.
He came in without credibility. He's not a serious person. Hassett was a very serious person, someone I held in high regard, and spoken with him many times. I'm far more disappointed in the trajectory I've seen with that Kevin than any of the other people in the economic team of Trump 2.0. Warsh, on the other hand, has not been in the economic team of Trump 2.0, which, much like governors that run for president, is an advantage. Senators often have a federal legislation vote that can come back to haunt them. Famously, Hillary Clinton voting for the Iraq War haunted her when she ran for the Democratic nomination for president. It's one of the main reasons that until an exception like an Obama and a Biden, and I don't think the Republicans have had an exception in a billion years, that senators have had a very hard time getting elected president, that we've largely gone with governors. Maybe they have more executive experience and talent, but also they've avoided federal votes. Had Warsh been there, would he have been a dissenting vote in 2022? I'm not talking about 20. Okay, I'm being gracious enough to give Powell a pass for the zero bound in 2020. I'm not convinced there is a central banker who wouldn't have done that based on the Fed Treasury Accord that you taught me about, that was hardly implicit at that time between Mnuchin and Powell, predecessor with Paulson Bernanke, that in those times of extreme 6 standard deviation left tail risk events, Fed and Treasury get on speed dial and they coordinate, and then they basically intervene heavily. And my view is that they shouldn't, but that if they're going to not do it, they have to tell everyone they're not. And when risk parity blew up in March of 2020, the moral hazard was such that they had spent 30 years telling these people they were going to, so they needed to. A lot of people don't like that view, but I think it's your view. Tell me, first of all, if we're tracking so far.
I totally agree. I mean, look, I think the great part about a Chairman Warsh-led Fed is that he's been very consistent since he was on the board in 2006, was that he was always very in favor of powerful, forceful measures by the central bank in times of crisis. This goes back to Walter Bagehot, right? This is lender of last resort type of central bank activity. The difference is that when the crisis subsides, then you need to go back to normal operating procedures so that markets can do what they do on price discovery and the allocation of capital. That process needs.
I want to give listeners a quick intervention here, because what Rene's saying is very important. What he's talking about is nothing more than extreme policy in an extreme moment, then moving to normalization, where what Ben Bernanke and Japan and Draghi, and I could go on, have done is say, no, we can't go back to normal because the intervention is now so baked in that it will create another problem if we do. And that essentially it allows for a codification of normalizing emergency activity in the administration of monetary policy. What you're saying, Rene, is that Warsh has never bought into that he has been a consistent emergency for emergencies, but no emergency for non-emergencies.
That's absolutely correct. And when you look at Chairman Warsh's record in 2011, when he stepped down, the reason he stepped down was because of this expansion of the balance sheet, where QE was no longer an emergency measure, but was becoming a permanent instrument of monetary policy. And what effect did that have? There are always trade-offs in policy, as David, you've pointed out. The question is, which cost is greater? And there are obviously costs to normalization of policy, but the flip side of that is that if you continue where emergency measures become normalized, then what ultimately happens is that you begin to monetize the fiscal largesse, and that there is no market discipline. You start to truncate the market discipline on the fiscal policymakers. And so it's no coincidence that, starting with this large expansion of the balance sheet, that tracks with the expansion in debt to GDP. And what has that done is that has created a tremendous misallocation of capital, and where the price discovery process has been impaired because the central bank and the government has such a large footprint in the market. So I think that's where the real big regime change is coming in central banking, is that the footprint of the central bank and the government is going to be right-sized, and that capital that is essentially trapped in reserves inside the Federal Reserve will be unleashed into banks in the private sector.
So let's talk a little bit, without getting too wonky, about how he'll do that, and then we can move into some global and geopolitical affairs. Do you believe he's going to come in and revert to a shock and awe quantitative tightening? Do you believe he's instead going to do a quasi operation twist with the duration profile of the Fed's balance sheet, or something else? What would the means be of reducing the footprint via the balance sheet for Warsh without being hyper disruptive to markets?
Look, I think the most important thing to remember is that there needs to be, and is going to be, I think, a new demarcation of the roles of fiscal policy and monetary policy. And in all likelihood, that is going to be codified and articulated in a new Fed Treasury Accord. And hopefully that Fed Treasury Accord can be signed trilaterally by the Federal Reserve, the Treasury Secretary, and even the President of the United States, right? And without getting into too much technical stuff, right? The main idea is that over time, the Treasury and the Fed are going to work together to reduce the size of the Fed's balance sheet and reduce the footprint of the Fed in markets such that the Fed only intervenes when crisis necessitates.
So is that market manipulation to coordinate it with Treasury, or when the balance sheet is essentially composed of largely, Treasury securities, is that the only way to do it? In other words, by coordinating, what you're referring to is becoming a direct buyer or seller, enabling the Treasury to meet its liquidity needs and allowing that to simultaneously accommodate Fed objectives with reduction of footprint. Is that coordination an intervention, or is it a means to an end?
I think ultimately, look, it's that you don't want the Federal Reserve to be buying duration out in the long end and to start trying to mess around with yields that they can't control and that they don't control. So ultimately, it means just over time getting back more to basics where the Fed's balance sheet is full more of bills and short duration coupons rather than 10-year, 20-year, 30-year bonds and mortgage-backed securities. And that's going to take a process, and that's going to take a type of what we call duration transformation in the markets. I think you called it kind of like a reverse operation twist, right? But that's a process that's going to be, I think, very tightly managed and signaled without shocks to the market. And I think that the market will respond positively to that because it will ultimately, when you think about it, impose fiscal discipline. Because if the Fed is no longer buying long-term debt, then there's going to have to be a choice made by the fiscal authorities on what they should do. And quite frankly, if more of the Treasury issuance is in the front end, then actually, this is somewhat of a philosophical point, but I do believe it, that as the issuer of the global reserve currency, you should submit more of your fiscal issuance in the front end because it submits you to market discipline consistently, right? And the market gets a consistent negotiation on and a vote on what you're spending the money on and why, right? And that is the privilege that the reserve currency issuer has versus other emerging market countries that have to fund longer and more expensive.
Well, and also other developed market countries that maybe don't have that that prohibition that emerging market countries do, but also just do not have the economic growth, the trading footprint, the military respectability, any number of circumstances that keep them from being a candidate for that privileged status.
Yeah, I totally agree. So look, I think that's, one of the, I think, major market implications of this is something for us to think about here going forward is the president has been very clear on his request for the next fiscal year on the defense budget. And he says, look, he wants $1.5 trillion of military spending. Well, that's quite frankly 5% of GDP or close to it, which is in line with the Hague commitment of NATO that everyone agreed to last year. So that's a big number. It's an extra 600 billion or so from the current defense spending levels. And so the question is, how is the president going to finance that? And can he make the case for it? That we need it and we need to spend it. And that much like Reagan in the 1980s that came in as a fiscal hawk, but needed to increase defense spending, remember on SDI and Star Wars, as deterrence against the Soviet Union, then the president's going to have to make the case for that. And I think maybe he'll start to make the case for that this evening at the State of the Union. And then ultimately
So
have a negotiation with Chairman Warsh, right, on where this issuance is and how much he's going to be able to get through.
So what do you think I'm about to say? The comparison of Reagan SDI and the desire to ramp up defense spending as a percentage of GDP, but also in just absolute dollar terms in the 80s to prevail in the Cold War versus right now to prevail in a number of different global threats into the future. What is the key difference versus the 80s? You said it earlier. What was our debt to GDP then?
Yeah, it was, I think, under 50, somewhere in
It was
35.
under 50. It's over 100 now, counting just the public debt, not counting intergovernmental debt. Do you think that the challenge is not making the case for the legitimacy of our robust military in what has become a very complicated world, and that the challenge is not even the mechanics as to how to finance it with debt financing? Do you think the challenge is that our mandatory spending as a percentage of federal budget outlays and the size of our social safety net has gotten to a size that we no longer have the luxury of having a military of that size?
I think that that's absolutely correct. And so, the president is ultimately going to have to make the case to the markets that, quite frankly, will you give us one more round to try and see if we can get this done? And the adversaries, I think, know this. This is why they are, when you look across the landscape from Putin to Iran to Venezuela to even the Chinese, they know the position where the United States is right now. And they know the vulnerability, and they know that the vulnerability is in the markets. And so I think this is why the president is very intent on trying to reestablish deterrence, because you've got this financial vulnerability out here, right? And so you have to start doing a lot of other things in the military domain to try to reestablish and restore deterrence and to make it more of a safe world that's, safe for capex and US companies and all of the things that bring inflation down and increase real living standards and all the great virtuous cycle that we talked about in the late 80s and early 90s.
Mm.
That's where I think the challenge is today.
So the $1.5 trillion military budget is in the context of a world with an increasingly robust China, a increasingly uncertain Russia, the issues within our own hemisphere, obviously the constant tensions in the Middle East, whether they be Iran right now or another terror block another day, various uprisings in Pakistan or Afghanistan or Syria. You have kind of a permanent instability. And I'm wondering right now, not what you think in 5 or 10 years or what we could talk about has been the case the last 5 or 10, but as we're sitting here right now, what is the biggest global threat that you see between those various options? Let's just call it Russia, China, Venezuela, Middle East.
Look, I mean, it's a hard question to answer because I think it's all of them working in concert together.
Mm.
Rich Colby, the Undersecretary of Defense for Policy, made a speech in Munich a couple of weeks ago where he said that we now have to take into account that the adversaries in concert or opportunistically might simultaneously seek opportunistic aggression. So, let's maybe think about all the ones that you listed and just kind of take them in order from Venezuela to Iran to Ukraine to China. So we obviously had a very historic moment January 3rd this year with the Maduro exfiltration. Probably one of the most complex military operations in history, conducted seamlessly. And what was the point of that? Speaks to the earlier point that I was trying to make, which is that you needed to reestablish deterrence. Everyone thinks that this is about regime change in Venezuela. It's not about regime change. The Chavistas are still there. The regime is still there. There's one guy, that's two people that are gone, and those people arguably weren't running the country anymore. But it's that you needed to demonstrate to the world that the US military, particularly in the wake of the Afghanistan withdrawal, could still execute very complex missions as a form of deterrence and deterrence signaling. So there's, I think, another dimension of Venezuela, which is that in theory, the Trump administration is betting that they can get this new regime to act more in aligned with US interests. And how are they going to do that? They're going to do that with an oil embargo. That's why you have the Armada in the Caribbean, right? So I think that is the blueprint when you think about with Iran. Now, today, it's the same thing. You have this similar Armada being now shipped over to the Middle East. And when you look at the force posture and all the military assets that are in the region, they're not there for a ground operation. They're not there to snatch the Ayatollah and bring him to the Southern District. They are there, I think, to tell the supreme leader, either you step down the hard way or we can take you out. And in the hopes that, similar to Venezuela, the IRGC regime that, runs, let's call it 25, 40% of Iranian GDP and controls the economy, will be more incented to align with US and regional interests economically. And quite frankly, what's the leverage? Not just all the kinetic, but again, on the oil embargo. So we'll have to see. And why is the president starting with Venezuela and starting with Iran? I always use the example that the president likes to enforce deterrence by using enforce deterrence against non-nuclear states to work up to deterring the nuclear states like Putin. So if you can demonstrate to Putin that, hey, we took out Maduro, we took out the supreme leader, you might be next, then he can achieve a couple things. Number one is to finally, hopefully, bring Putin to the negotiating table and bring the Ukraine conflict to a close.
Do you think he's done that yet? Do you think he's made any progress in doing that yet? Do you understand why skeptics think that he's made no progress in getting Putin to the negotiating table?
I mean, look, there has been, I think, relative progress to 2024. You actually now have, I think it's almost 5 meetings now between the Russians, the Ukrainians, and the Americans at the negotiating table. During the Biden administration, there was none of that. So there is some progress. There has been progress on the Ukraine side, where the Ukrainians have, quite frankly, received a security guarantee from the United States. And so the question is, what is it going to take to get Putin to sign on the line that is dotted? And ultimately, you have to convince him that the cost of continuing is going to be greater than the cost of signing the deal. And look, I mean, we're still far away from that, because there's some arguments to be made that Putin still thinks that he can wait out Trump or wait out the United States and test our resolve. And so I think these operations against Venezuela, against Iran, are ways of playing cognitive warfare with Putin. And so I think we're going to have to see here in the next coming weeks if they work. So I think kind of that speaks to the final big challenges is with the PRC and China. I'll say this because there's we could have a whole separate podcast on China and US-China relations and all that. But I think you can ultimately boil it down to the following is there's been a lot that has happened in China since COVID. And I will argue that the things that you have seen, particularly all the crackdowns and purges not just across, the Communist Party, but particularly in the military and the PLA, is that those are signs of weakness and signs of increasing brittleness inside of the Chinese system.
Economically, politically?
And culturally.
Okay, all the above.
I think all of the above.
Okay.
There was a great Substack that a young man from China wrote, where he articulated that all of the developments that you have seen in China today, that those are all very recent phenomena. They are things that, all the great infrastructure and the consumption and the advances in technology as late as the mid-90s. I mean, he made the example that Chinese gangs were still running the streets in Shanghai. And if you talk to people that were there in 1992 after the wall fell and the Soviet Union collapsed, was that there was nothing modern in China. And it was still mostly Maoist type of, kind of propaganda that you could still see on the street. So why am I telling you that? I'm telling you that because I think that the Chinese people do not want to go regressive and retrograde back to the 80s and 90s of the post-Mao era. But if Xi Jinping and his cohort continue along this trajectory, I think it's very clear that that is where they're going to go. And I think that that outcome, when collectively the Chinese people realize that they will not sustain that. They will demand different leadership, much like they did in the Soviet Union. And so maybe this is the last point to make on this. And, I always encourage our colleagues in the Department of Defense and across the U.S. government and the interagency to think about that there's a world in 2035, 2040. Call it a post-Trump, post-Xi, post-Putin, post-Ayatollah world. And we need to think about what that world looks like. And so I know today we're in this very doom and gloom kind of sell America narrative in markets. And I think that's part of the price discovery mechanism today. But I think when you kind of look out the landscape, depending on the decisions that we make, then I think things could look very differently than how they feel today.
Rene, we talked about market discipline and how it has constrained President Trump, whether he likes it or not, particularly in the more obvious example of post-Liberation Day. And we've talked about the underlying principles of market discipline as almost this sort of sovereign reality that exists whether one believes it or not, much like gravity. You don't have to believe in gravity to die when you fall off of a building, right? Is China, and particularly Xi, subject to market discipline when it comes to their interest in Taiwan and their intentions in Taiwan as it pertains to China's economic objective of having a stable currency, of having a stable bond market, and having those things facilitate their ability to expand trade with other trading partners in other Asian countries and European countries in particular? It is market discipline keeping China from becoming more imperialistic with Taiwan?
I think that is the constraint. I think that's the reason that they haven't done it yet. That's the reason that there has been no blockade around Taiwan. And I think a lot of defense people and other policymakers in Washington don't like to articulate it this way. But the deterrence against invading or annexing Taiwan is not our aircraft carrier out there. It's about day one or day two of what happens after that. Because quite frankly, the example and norms that we set with Russia post the invasion of Ukraine, if you were to just take that same slate of actions and then conduct them against China, clearly that would have an impact against the United States. I want to be clear about it. There would be pain in the United States, but there would be far greater pain on the mainland in China if that slate of Putin-style sanctions were to happen against the PRC in the wake of an invasion or a blockade or some kind of use of force. So look, I think part of also what the president is doing in this ongoing negotiation with the Chinese is to continue to sell them the much vaunted and valuable chips that they need to obviate the need to invade Taiwan. Because it's been decided that we're going to compete not on chip access, but on end use and applications, and ultimately the capital allocation process that you could argue is more efficient in the United States than it is in China.
Who do you think has gotten the best of whom since Liberation Day on U.S.-China trade discussions? My reading of the landscape is that China is receiving more chips than they were before, that we are continuing to receive the critical minerals that we were before, that they are marginally paying higher, that U.S. importers are paying higher for Chinese exports, with the exception of some of the major categories like iPhone components, for example. And yet when all said and done, Secretary Besson himself said last week, it was never about decoupling. This comes after declaration after declaration a year ago from various new right economic actors that we needed to decouple. Who's got the upper hand here a year later?
Look, I think what has been
the answer was Jensen Huang.
Yeah. Right. Ultimately, the Chinese have done something that was very, I think, positive on their part, or for them, is that they have been able to establish a certain type of deterrence against the United States. And that there is now this economic mad being mutually assured destruction, that, let's call it, truncated or stopped the escalatory economic cycle between the two countries. So I think that's, in the near term, maybe very positive for China, because the assaults from the Trump 1 to the Biden administration to, through Liberation Day last year were having real impacts on the Chinese economy. And I think that's very clear. Longer out, I do wonder, right, if this has set the foundation and the seeds for a strategic defeat. Because at the end of the day, the West is building an anti-China coalition, and they are, over time, delinking certain strategic supply chains, right?
Semiconductors.
Yeah, and a whole slew of other kind of strategic industries as well. That,
but with semis, that's less China specific and more Taiwan, right?
Yeah, but look, the Chinese are trying to develop their own chip sector as well.
Sure.
So I think there's a point there about trade integration. That
our nationalists are supportive of China developing their own chip infrastructure, right? Isn't that the way it works?
Oh, explain.
Well, I always am a little pokered when people in the U.S. who identify as nationalists and say we should have our own critical infrastructure capability around semiconductors, and you can say yes, we should. That seems to make sense. And then those people say China's trying to create their own infrastructure for semiconductors, and then they are opposed to it or want to disrupt it or view it as an act of aggression. And I'm trying to figure out what nationalism means, I guess.
Oh, look, I think ultimately this idea about protectionism
Yeah.
has already been proven to be a folly.
A folly because it doesn't work, which is one view, or a folly because it was never even the actual intent here, which is another. I'll be honest with you, because I don't want anyone to think I'm setting up my own friend here for a trick question. That's not what I'm doing, and I'm not doing it for listeners either. I would argue that protectionism is a failed idea, but I would also argue that it isn't at all clear to me that anything we've done over the last year was intended to be protectionist. The rhetoric started in 2015 and 16 protectionist. It borrowed from protectionism at different times in the campaign of 24 and at various speeches that, let's say, like a Navarro might have given in 25. But and I did a whole Capital record about this, probably more than once actually, that the Liberation Day issue really didn't end up seeming to me to have anything to do with protectionism. So do you mean it that they undermined it by their own execution, or just simply the protectionism proved to be a fallacious idea?
I have a question for you because I think you're touching on something very important. So, what do you think the intent of Liberation Day was?
So my answer, where I'm not being a critic of what happened, where I'm describing what happened, is I don't believe President Trump had a coherent objective. That with various rhetorical contributions from the Commerce Secretary Lutnick, from the CAA Myron, from the NEC Hassett, from Pete Navarro, from Steve Bannon, from the kind of wide array of influences, JD Vance, by the way, being perhaps a more serious one, and his probably being more protectionist. My own view is that President Trump's consistent intellectual strand here, if I could be so complimentary, is that he believes that the US is getting taken advantage of. And Liberation Day was his way of saying, we're going to do something that narrows the spread of how other countries are doing better than we are.
Let's see.
Identifying the formula for Liberation Day tariffs to the amount of trade deficit, connects to that.
I think let me interject something because I think you've touched on something very important. And let's talk about the president and the intent of the administration on what Liberation Day was really ultimately about, even though they will never articulate it this way. So I have this thing called pool shark theory, like a billiards player. And it's very simple. It's that a pool shark cannot actually do differential equations on a chalkboard. But if you get him in a pool hall on a Saturday night with $1,000 on the line, he knows how to do differential equations. And actually, he does them better than the mathematician because he's doing them with his body under pressure. So it speaks to a certain kind of intuition, or, Chairman Warsh talks about this all the time, that Polanyi's paradox, which is that we know more than we can explain. And so I will give the president something that I think is very important, which is that he's a very intuitive guy. And I will say maybe mostly only intuition. And so what does he know as a former real estate developer that is very acute on balance sheets? Which is that when he looks at the U.S. balance sheet and the U.S. fiscal position, and he said it numerous times, that we've got $35 trillion in debt and we can never pay this back. Now, he knows ultimately that we have to raise revenues, but he doesn't want to raise revenues on a fiscal consolidation. So he tried some other things. The first thing was Doge, remember? Didn't work. The second was then Liberation Day and the tariffs. Didn't work. So what do you got now? And I think this kind of leads back to where we started, is this is one of the main reasons why he did nominate Chairman Warsh to the chairman of the Federal Reserve, is because deep inside he knows that the central bank was the one that was enabling all this fiscal largesse, and that if he can put Chairman Warsh in the seat, that will, without much fanfare, put a lid on the spending, bring long end yields down, raise revenues through a supply side productivity stance of monetary policy, which will at least hopefully give the United States the chance to avoid bankruptcy in Chapter 11, which he has been in numerous times. So I know that is a very kind of roundabout way of explaining what Liberation Day to them was about, but I think that was a very interesting way that we got there.
So you believe that the president consciously thought that Liberation Day was a way of generating revenue to ease our debt burden?
I do think that he thought that. At least he was going to try it.
Would someone who's concerned with that talk about spending every now and then?
Yeah, but the question is on the president's spending. They're not really that serious. What did he put in? Tax on tips and, stuff that is small potatoes in the budget.
Right, but the question is, what did he cut?
Zero, because he, would, like every good politician, wants to try the easy way out.
Mm-hmm. But you brought up the precedent of him being a real estate developer for 4 or 5 decades. I think that's a very fair analogy presidentially, that I never saw him as a real estate developer be concerned with that side of the ledger. It was if there was any way of addressing excessive leverage, it was in getting better terms from his lender. It was on the borrowing side, never constricting the borrowing, never even really increasing the income side, right? It was just simply trying to generate leverage with the lenders so that he had the upper hand. And the national picture doesn't seem to create a very good analogy. I think that, but on the other hand, he also couldn't print money, right, to issue new debt in the private sector either. But I guess that the analogy I'm making is that I don't think he cares about excessive leverage. And then when a borrower is in trouble, he views it as the lender's problem.
Well, it's interesting because now the lender's problem is his problem, right? So that's where we've come full circle on it. And I think he's ultimately had to take in the lessons and the market discipline, which is that you're going to have to grow your way out. And you can grow your way out through a mix.
What has given him that lesson so far? That that from 22 to 24, when he was out of office, the yield curve moved up 200 basis points, 300, 400 basis points. What has given him the lesson that they've had no trouble with any issuance?
Yeah.
Look across the entire curve, both in terms of term premia, but even just at the short end, it's not a particularly expensive cost of capital. What would give him market discipline? I think you could allude to things that foreshadow it or that threaten to, and maybe behind closed doors, Secretary Bessent tells him this is going to happen if you do this or don't do this. But I'm not sure I see it yet that the president's worried about being constrained by U.S. fiscal largesse.
Look, I think maybe, let's just conjecture here, that maybe the president is more long-run focused and strategic in his thinking than we think. And he actually has more of an idea about what the legacy is. And I don't think that he wants to be the president that presides, it's known in history as presiding over, the demolition of U.S. markets. Because what I call the Ken Griffin moment, right, which is that there's a day when we wake up where the bond vigilantes say no mas. And we've gotten glimpses of that here in the last year, that I think ultimately between the mix of the supply side measures, the Chairman Warsh nomination, and ultimately trying to pay down the debt and increase tax revenues kind of by hook or by crook, right, I think speak to that.
So with the the question about China, is President Trump art of the dealing, President Xi, or does he want his approval? And then same question with Putin.
With the Chinese, with Xi Jinping, here's how I think that the president thinks about it: is I'm not convinced that the president is a China hawk per se. I think that's very clear. I think that ultimately, again, and this is something that I think the president gets to very intuitively only, which is that what you want from the Chinese is a change in their behavior, not necessarily a change in the regime. And the change in the behavior is that, quite frankly, you're going to play by the rules and we're going to rebalance the relationship. And that is the real objective, even though sometimes it's not always articulated that way. But what's the point of that? Because ultimately, I think over time that, and this is very important, if you can get the Chinese Communist Party to abide and behave by markets-based principles, is that over time, that becomes incompatible with an authoritarian regime. And again, that's the power of markets. With Putin, I think it's also very similar. Well, I mean, I think a lot of media like to talk about that the president admires Putin. Look, there's been no president that has been more hawkish against Putin than Trump. We have to give him credit for that. Could he continue to be more hawkish? Yes. I think the reason that he's not is because he's spooked by the nuclear weapons. But that's not just a fault of Trump. President Biden and all presidents kind of before him have been very spooked by that. But I think what the president is trying to do with Putin is to, let's call it rope-a-dope him or trick him into coming to the negotiating table on some quote unquote deal that he can sell back home as a win, because he knows the very poor standing and position that Putin is at home. And that if he can convince them to just leave the battlefield and go home, the Russian people will take care of it. And look, if there's an argument for why the Ukraine conflict will continue to escalate, it is that Putin also knows this, because there is arguably no dacha that Putin can go back home to, right? And so he has to take this to the last full measure of devotion. And I think that very grave decision is what weighs over the president. And I think why he's trying these other measures in Venezuela and Iran to try to solve that very intractable Putin problem.
So, Rene, we've kind of gone around the globe a little here. The president, by the time people are listening to this, the State of the Union will have been delivered. He may refer to Iran tonight. I don't think he's going to tell the country what he plans to do, but we know the Iran issue lingers. You've had some just profound observations and thoughts, I think, on both Putin, Xi in China, the overall objectives with Venezuela and what they meant in terms of a bigger picture. And then obviously we've discussed Warsh, the Fed, and the subject of market discipline. There's one last thing we'll close up with, which may very well be the biggest issue for investors in the US, which may very well be the biggest issue for domestic economic policy right now. And that is OpenAI. You have a note in your notes to me. We already discussed the $1.5 trillion defense budget, and you put $1.5 trillion defense budget versus bailout OpenAI. And of course, nobody is aware that there's a bailout going on for OpenAI right now, because there isn't. They continue to get paid and they continue to make purchase orders with NVIDIA and to raise equity capital in their sort of tri-party circular funding model. But what you mean here is that there is this accumulation of capital expenditure commitments that surely has a quasi
Yes.
Governmental backing behind it, because if OpenAI were to collapse with $1.5 trillion of expenditures, the domino effect here is systemic. Is that what you mean? And tell me how you think about this developing web from data center to the hyperscalers, to the language model creators in this rapidly evolving AI economic story?
So let's just start with, I think you, David, in 2008. I think there is no greater scholar of the 2008 global financial crisis than you.
Thank you very much.
We all know that. And what did you call that? Very famously, a crisis of responsibility. Okay. So it has always been my contention, and we've talked about this for many years now, that the costs of 2008 and the bailouts were not paid in 2009, 10, 15, etc. They were actually paid in the pandemic, and maybe they're continuing to be paid now.
Yeah.
So I say that as background context to make two other points. Number one is that when you think about the AI trade and the whole generative AI theme, is that came in the wake of the war in Ukraine. It's not a coincidence that was what was a natural outgrowth. And remember, at the time, we were also in a very heated confrontation with the Chinese. So we are now thinking about technology not just as a supply side accelerator, but as a component of quote unquote national security. And national security oftentimes is seen as a sacrosanct thing that anytime you slap a national security sticker on it, you can't question it. And so I bring all this back to 2008 because I think what a lot of the founders in the generative AI, let's call it industry, have discovered is that the lesson from 2008 is to make sure that you don't become Dick Fowler and you want to become Lloyd Blankfein. And how do you do that? You do that with this web of becoming, quote, too big to fail with an implicit government backing. And in the same way that, the banking system rightfully in 2008 was so core to US markets and the US economy because of the expanded state footprint over time, is that is, I think, the strategy of most everyone in the tech sector under this rubric of national security, right? Which is that, we need government support if indeed the revenues do not match the capex over time. So I will tell you, that is a subject that is being discussed across the United States government, across the tech sector currently. And I think that might be one of the first challenges for a new Fed chairman, is to think about how that might work and to think about what the implications are of, I'm going to call it, eroding competitiveness in the technology sector.
So I'm going to have a guest on Capital Record again next week.
Nice.
Two very special guest editions. A gentleman by the name of Tim Estes, who is one of the leading experts, I think, on matters of AI policy in the country. And he's going to share a number of things. I'm wondering, Rene, if I can get you back on later in the year where we do a dedicated discussion of this AI issue in the context of what you're referring to, because what you're doing here is fascinating. You're pulling together the reality of the AI technology, the evolution in the space, the funding model that is evolving quickly and in a rather troublesome manner, the moral hazard that's forming underneath it, and how a national security pretext can be used to rationalize U.S. involvement, and then even the capital markets crisis that such a disruption could create for a central bank.
Well, let's make kind of maybe two final points on this. And I know we've been going for a while, so let's just close on this, right? there is a feature of the current tech wave that is indeed transformational. And as Chairman Warsh said, actually, I think several months ago, that in the future, we're not going to talk about this as AI. We're just going to talk about it as just how you conduct business. And it is the seeds of a tremendous productivity boom. In fact, you're already seeing it. When you look at the labor market revisions over the last year, where there's actually less employment, but profits are up, that's the garden variety signal that we're in a productivity boom, and arguably productivity is running at least between 2.5% to 3% per year. So that is a very positive thing. The irony is that if you then concentrate those creative impulses in a handful of companies that are given implicit backing by the government, it stifles competition and actually reduces the positive supply side impact if you were to do it. And I'll mention that this AI doomerism that we have amongst a lot of, I'll say, secular people, that this is just new Tower of Babel stuff, right? That they spoke about nuclear and nuclear energy like this in the 1960s and 70s, and that we needed to restrict it, and that it was too dangerous, et cetera, et cetera. And what were the impacts of that? Is that then the adversaries realized that we were energy constrained, and so they did the oil embargo in the 70s, and we had inflation, et cetera, up until 2005, where the president, after 9/11, had to say that we were addicted to oil. Now, the great part about capital markets, and this is, I think, the perfect story for Capital Record, was that in January 2006, the State of the Union, 22 years ago, almost to the day, when President Bush said that we were addicted to oil, and so we were going to invest in alternative energy sources and technology to wean us off of Middle East oil in the next 15 years. There was a guy named George Mitchell down in Texas that was already working on that problem that the government had claimed that they were there to solve. And 15 years later after that, what did you have? An extra 10 million barrels of oil from the shale, another 3.5 million barrels out of Iraq, and Tesla. Now that is far beyond the wildest dreams of any one bureaucrat in the Department of Energy could have ever had in 2006 with a little program, right? And this has strategic stability implications, because imagine if on this day 4 years ago, Putin had invaded Ukraine without the additional supply of 10 million barrels from shale and 3 million barrels from Iraq and Tesla. He would probably be sitting in Paris right now, because the oil price would have gone to 200. So this is, I think, a story that I think is very important. It's one of my quintessential stories, that you've got to get the government out of the way and let the markets do its work. Because if you let the markets do its work for you, it will reward you in ways beyond your wildest imagination.
Rene, we could go on all day, my friend. I can't thank you enough for your time, your wisdom, your perspective. We have like 4 more hours of things to cover, but we'll do that without a microphone, but with a veal chop.
Yeah, I can't wait to come see you.
54th and Madison. You know what I'm talking about.
As always. Great to see you, brother. Thank you.
Thanks for everything, Rene. We're going to let this thing close out here. Thanks very much for listening to a long discussion between me and Rene. Thank you, those who support Capital Record, support this cause and mission. And we look forward to having Rene back on, as always. And we will continue doing what we do here, which is acknowledging market discipline as a God-given constraint in a fallen world. And we look forward to what greater access to markets can do for human beings who were made to create wondrous things. Thank you for listening to David Bahnsen's Capital Record.